Hi, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the third quarter, both bonds and stocks slipped some. Inflation rose a tad, finishing at 3.7% in September from June's 3%. The Federal Reserve again increased short-term interest rates one paying only by 0.25 of 1%, a quarter point. A few signs of a slowing economy are surfacing. For the year, U.S. large companies are still up 13%, powered by a few. U.S. small company stocks are eking out a positive 3%. International companies follow suit at 5%. Bonds slid below the waters, down 1% for the year. The Federal Reserve sat tight at their September meeting, holding rates at 5.25% to 5.5%. We've just reeled through the fastest rate hike in history and are waiting for the economic consequences, slowdown, to catch up. Gross domestic product, GDP, grew by 2% in the first and in the second quarters, and the Atlanta Federal Reserve's estimate is an impressive 5% for the third quarter. Retail sales were flat over the quarter, but slowed a bit for big-ticket purchases. The August JOLTS job openings report showed that job openings increased. The percentage of people participating in the labor market continues to tick up. The September jobs report showed a boom of hiring. There's been a spate of strikes this quarter from UPS workers, the Actors Guild and Writers Studio unions, and the UAW at Ford, Stellantis, and GM. Executive pay is very high. Mary Barra of GM made $29 million in 22. Ford's Jim Farley pulled down $21 million. Both of those strengthen workers' demands on these strikes. Wage growth, a component of inflation, was 4.2% annualized in September. The CPI at 3.7% is still above the Federal Reserve's 2% target. Politics could be better. Congress, the House, sidestepped a government shutdown at the last midnight hour and then fired the House Speaker. Now they have 45 days to reorganize and deal with the deficit before another shutdown looms. Shutdowns usually do not affect the stock market, but the historical data we have only covers short lapses. Nothing prolonged. What matters most in all of this? Interest rates and earnings. Interest rates have run up recently. The 10-year U.S. Treasury note is hovering close to 5% now. That's a tall headwind for businesses and consumers. Mortgage rates are well over 7% now. Earnings for the S&P 500 large companies came in at negative 5% for second quarter 2023. Predictions are for a positive 0 to 3% for the third quarter, followed by a positive 9 to 11% jump in the fourth quarter. 2023 is expected to finish at a 1 or 3% earnings growth. Earnings are expected to grow 12% next year. The stock market is valued at an above-average multiple of earnings, even after the recent pullback from market highs. It's unlikely the Fed will be cutting rates soon, so near-term market gains would not come from that corner yet. Barring a recession or an economic clip from an unexpected quarter, we may have a sideways or rolling market. Good earnings growth might further highs. We'll see. Europe and the UK overseas are still encountering inflation higher than ours. Their central banks are expected to stop raising rates soon, just like ours. Their economies are not as robust as ours. Plus, they're still dealing with the effects of Putin's war on Ukraine, and now the terrorist war in the Middle East is close by. Overseas markets have returned about the same as ours over the last 12 months. China is expected to recover soon from its economic malaise. Even so, their economic GDP growth of 5% projected for 23 exceeds that in the U.S. Our portfolios are diversified over different asset classes, stocks, bonds, alternatives, and they're diversified over different geographic locations. here in the US and overseas internationally. We're still benefiting from stocks this year. Bonds are not lending a helping hand as expected, but at least they're not hurting returns. We've diversified those as well over distinctly different types of bonds, spreading out the risks that any one type of investment gets hammered and sends the whole portfolio return down. As long-term investors, we know it's important to watch both risk and return. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.